Hi there, welcome to our webinar. My name is Jamal Khan. I'm a senior tax partner at Churchill Tax. Today we're talking about the property portfolio trap for landlords and how you work hard, you collect your portfolio, and ultimately becomes a problem for you and for your children because the government wants 40% on it when you die. So I will quickly go through some of my slides. I will not go into too much detail, but at least to give you an idea of what to watch out for. And when we do my next session, I can dig into a lot more detail. Right. Okay. Let's see if it works. Doesn't seem to be working. Give me 2 seconds. Right, I'm not able to share my screen. I'll give it a try. Right, here we are. Sorry about the technical confusion. I hope you can see my screen. If not, then I'll walk you through it anyway. This is some information about us. And today we're talking about the property portfolio trap, incorporation of properties, and special purpose vehicles. There are some other areas that we will cover in our next webinar, but today we will cover the property portfolio trap. Essentially, when you do acquire properties and you build portfolios, you have two problems, and if you want to pass it on to the next generation, if you gift the properties to the children, you end up paying tax at about 28% capital gains tax. And that will happen during your lifetime. And when you make that gift to your children as you're getting older, you will have to pay capital gains tax within 30 days. Even if your children, it used to be 30 days, now it's 60 days. Even if your children do not pay you any money for those properties. So if a mother or a father gifts a rental property to their children, the tax on that will be calculated at market value, and which will be effectively at say around about 28%, the tax on that, capital gains tax on that. And before it used to be, in past it used to be you paid tax next year, but now they've brought that forward, so you don't have a choice. Essentially, you have to pay within 30 days, or now 60 days. And if you don't do that, then you start incurring penalties, daily penalties, and you've got quite a few problems. So that's one of the side of the trap, is that you have to make a gift, and if you make a gift, you have to pay capital gains tax on that. The other side of the trap is if you do not make a gift to your children, then you are subject to inheritance tax at 40%. And that could be quite problematic if you, for example, you're aged 50 now or 60 now, and your portfolio is worth say £5 million. One choice is to gift your portfolio to your children and pay the tax at 28% on the profit, or if you don't do that, you that 5 million, say 40% of that 5 million is say 2 point something percent, 2 point something million. But say you don't die when you're 55, you die when you're 70, and by then the property portfolio has increased from 5 million to 10 million or 15 million, the value of that portfolio. Now, the tax that will be applicable on death will be that 40% of the 10 million or 15 million, which could be a substantial amount, and children may struggle to be able to pay that. So we call it the property portfolio trap, and a lot of landlords have this problem where they don't know, and I've actually seen some landlords receiving tax advice from their accountants to say it's better to gift the properties to children and pay tax at 28% on the profit rather than to pay inheritance tax on death at 40% on the entire amount. But there's a distinction between the two. So if you gift a property to children now and you bought the property for 50,000 and now it's worth 100,000, or for 500,000 you bought it for and now it's worth £1 million, which is more realistic. So you would pay 28% on the profit, which is essentially 500,000. So you pay tax at the profit and the market value at the time you bought it and the market value you gifted to children. But if you die with that property, there is no tax on profit. It's inheritance tax is applied to the whole amount, the entire 1 million, rather than the profit element. So some people say it's better. I think, in my view, it's both of them can be handled. It can be mitigated. And there are some structures that we talk about in our subsequent webinars, which time is limited today. But there are some options available which allows us to completely eliminate the capital gains tax and the inheritance tax altogether. So I'll cover this in my next webinar. But it's just this webinar is to kind of bring awareness to people so that you know that if you do not address this issue, it will become a problem. And I get lots of families that come to me where parents have grown older or parents have passed away, and the children now are having to pick up the pieces because the parents did not do any tax planning. I've seen people losing their houses because of the inheritance tax. It can become quite a problematic issue for many families, where people leave tax planning or avoid tax planning. One of the main reasons for this is that people think that they're not going to die soon, and they can delay and procrastinate over this. And they will at least not doing anything until somebody has a heart attack or somebody's diagnosed with cancer or something, and then they will keep on delaying it. And when it hits the fan, then everybody comes running to tax advisors and saying, "Can we do something now?" And we say, "Well, we can, but you need a certain time period, like 7 year clock, 7 years for this to be fully effective. And you need to be alive for the next 7 years." So it's something to be very mindful of, in my view. And as I said, I'll cover this in a lot more detail in my next webinar. The next point is a lot of people are talking about incorporation, essentially, which means transferring your properties into a limited company. And I've dealt with dozens of these situations, many, I'd say dozens, but I mean hundreds of these situations, where somebody comes to me reaching their 50s or 60s or in their 60s, and they've got, say, 20 properties or 15 properties or 30 properties, and they've received advice from somebody that, okay, put it all into a limited company. Okay, why are you putting it into a limited company? Because I've got to take care of inheritance tax. Now, if you're transferring properties into a limited company, the one thing it doesn't work one thing that there is no benefit is inheritance tax. In fact, transferring properties into a limited company can make your inheritance tax situation much worse, because you will continue to own the shares in that limited company. You cannot gift the shares in that limited company to your children, because if you gift the shares in the limited company to your children, that will trigger a capital gain, and then you have to pay capital gain tax out of nowhere, without having even sold the properties. So something that needs to be mindful of. Yes, limited incorporation, and we do incorporation for many of our clients, as long as they're aware that there is no inheritance tax benefit. What it can do is incorporation can help you with claim tax relief on mortgage interest, full tax relief on mortgage interest, which is quite good at the moment as we speak. But the rules may change, because currently individuals do not get tax relief. Individuals who are higher rate taxpayers do not get tax relief at the on mortgage interest at the higher rate, but companies do. Now, there is talk in the market about people who the same rules applying to companies as well in the future, i.e. the companies will not be able to claim tax relief on mortgage interest. And if somebody's transferred all their eggs into one basket, I mean all the properties into one limited company, and the rules change, that the same rules apply to limited companies, and they're stuck in there, and they can't come out. So there is tax relief on properties going into a limited company, which is mentioned as CGT 162 and Stamp Duty 175. But what you need to be aware of, there is no relief, no similar relief on the properties coming out of a limited company. So once again, that's called the incorporation trap. And a lot of people fall for that purely because of they're not having enough knowledge, not having seen a specialist about this. We do see a lot of people who do come to us to incorporate their properties, and we do help them, because their concern is not inheritance tax. Their concern is they want to mitigate their income tax. And in fact, if you incorporate your property portfolio and you sell those properties once they're transferred into a limited company, you can essentially eliminate the capital gain. So if the property value, you bought a property for say 100,000, now it's worth 500,000, and if you sell it now, you'll pay capital gains tax on 400,000. But if you transfer your properties into a limited company and then you sell it, then there is no capital gains tax to pay, because the company just acquired the property from you at 500,000. So if the company was to sell it immediately after incorporation for 500,000, there's no capital gains tax to pay. But this could be quite advantageous. A lot of people who I've advised are able to do that, and have been able to do that, and then use the extra money to invest those proceeds into some further bigger property projects. Okay, so there's some useful nuggets here for people who are watching this, and people who like to look at tax planning for landlords. But if you've got any questions, you've got my contact details. You can contact me, but in my next webinar, I'll be exploring things like trusts and other options to LLPs, partnerships, to get in more detail of tax planning for landlords, and how to mitigate your inheritance tax and capital gains tax liabilities and income tax liabilities. Thank you very much for watching. Thank you.